Good morning, students. Good morning to all. On yesterday, we have studied about the types of insurance. So today also, just we will studied and reminded what we have studied on yesterday, and we will go to the next concept. Yesterday, we have studied the types of insurance, and in the types of insurance, broadly classified as two types. One is the life insurance and the non-life insurance. And the life insurance also classified as a five types: whole life policies and endowment life assurance policies and joint life policies, annuity policies and children endowment policies. So today we will study about the non-life insurance policies. This non-life insurance policies also classified as a two types. One is fire insurance and marine insurance policies. First we will study about the types of marine insurance policies. Now first we will study about the life fire insurance policies. So fire insurance is a contract whereby the insurer, in consideration of the premium paid, undertakes to make good on loss or damage caused by a fire during a specified period of the amount specified in the policies. So fire insurance policies is a contract between the insurance companies and the insured. So in consideration of the premium paid, because different type of the premium amount policies, the different policies are there. So on the basis of the policies, that different amount premium has to paid. So only for the goods, any of the goods are getting loss or damaged caused by a fire only during a specified period up to the amount specified in the policies. So till the premium is paid, the policy is covered. A claim for loss by fire must satisfy the two conditions. First, there must be actual loss. If you are taking in the fire insurance, the fire insurance must be as the actual loss, because some of the peoples are voluntarily damaged the vehicles and their goods. So if the insurance companies come to know about the real matter, they will refuse to compensate the insurance amount, and they have the power to make the sue in the court. Next, fire must be accidental and non-intentional. Suppose as I told, the fire accident always happened as a accidental. Accidental means suppose if the any of the crackers may damage the goods, and some of the sunlights also may be the cause of may the fire accident. So like that, some accident must be accidental and non-intentional. The essential elements of the fire insurance contract is: the insured must have insurable interest both at the time of insurance and at the time of loss. So as I told already, when the insured must be having the insurable interest in the time of making the insurance and in the time of loss the commodities. When he has used the vehicles or the goods, he has some of the profit, and when he is losing that goods and vehicles, he must get some of the losses. Next, the contract is based on the principle of utmost good faith. I think you have remember on the principles of utmost good faith. So utmost good faith means the both of the persons, the insurance company and the insurers also must expose their informations on the subject matters. The insurance company must be informed about all the details of the insurance policies, and the insured also have to inform all the characters and features of the subject matter. And it is based on the principles of strict indemnity. Strict indemnity means, in this case, the insured will never get more money than their paid amount or actual losses. Next, the fire must be the proximate cause of damage or loss. So, if any of the fire accidental is going to happen, the accidental cause must be the proximity. Proximity means proxo max causa. Next, the marine insurance. The marine insurance is a contract of insurance under which the insurer undertakes to indemnify the insured in the manner and to the extent thereby agreed against marine losses. So many of the marines are going in the sea and the marine owners also involved in the types of losses. So in this case of marine insurance, the insurance companies are agrees to compensate the loss of marine in the period of activity of marine, and the insured also has to agree to pay the considerable premium paid. The insured pays the premium in the consideration of the insurer's guarantee to make good the losses arising from marine perils or perils of the sea. So here also some of the essential elements of marine insurance contract. The marine insurance contract is based on the principle of indemnity. Indemnity means so the marine owner will never get the more profit than their actual losses or the equal to the premium paid. Next, the contract is based on the utmost good faith. So here also the marine insurance also has one of the objectives of utmost good faith. So the both of the insured and insurance company has to inform about their all the details. Next, the insurable interest must exist at the time of loss. So when the time of loss, the marine owner and the insured must be has the insurable interest of loss. Next, the principal proximate cause will apply to the marine loss also. Suppose intimately or some coral, the marine or the ship may be get accidental, but the accidental must be arising as a accidental. Next, the types of marine insurance. In this marine insurance may be classified as the different types. First, hull or ship insurance. When a ship is insured against any type of danger, it is known as hull insurance. This policy is taken to indemnify the insured for losses caused by damage to ship only. In any course of time or in any of the reasons, if the ships are involved in this or stuck into the accidental or losses are damaged by the ship, the insurance company will be compensate the damage of ship. Next, cargo insurance. So when a marine insurance policy is taken by the cargo owner to be compensated for the loss caused to his cargo during the voyage. Voyage means in the time of travel. So it is known as cargo insurance. So when the time of transporting, so the ships are moving from one place to another one of the places, if any of the problem is raised, the cargo owner will get the claim. So the cargo to be transported by ship is subjected to many risks like risk of theft, loss of goods in voyage, etc. Next, freight insurance. When a marine insurance policy is taken to guard against non-recovery of freight, it is known as freight insurance. So the shipping company is mainly interested in freight. Freight means hire, the rent, okay. So which it gets either in advance or on the arrival of goods. However, it will not get the freight if the goods are lost during transit. So, to insure the freight, it takes freight insurance. So, in the exporter and the importer also using the cargo, but in the time of using the goods from the import or from the export, the freight may be missed by the both exporter or the importer. So whenever the freight is going to loss, the insurance companies will be compensate the freight. So it is called freight insurance. A contract of marine insurance covers the ship, cargo and the freight also. Next, health insurance. In middle of 80s, most of the hospitals in India were government owned and treatment was free of cost. So with the advance of private medical care, the need for health insurance was felt and various insurance companies introduced health insurance as a product. So presently the health insurance exists primarily in the form of mediclaim policies. So before, once upon a time or till the 80s, the government hospital only was there to produce the mediclaim policies. And but after the 90s 95, the arrival of individual or the private hospital was increased abundantly. But the poor peoples and the middle class peoples are were not able to get the hospitality facilities from the private hospitals. So because of that, all the people are felt the importance of the health insurance. So health insurance policy is a contract between an insurer and an individual or a group in which the insurer agrees to provide the specified health insurance at any agreed upon the price or the premium. The disability resulting from illness or accident may be peril to family because it not only cuts off income but also creates the large medical expenses. So health insurance is taken as safeguard against rising medical costs. It provides risk coverage against unforeseen health expenditure that may result in financial hardship. So whenever we are going to take the day by day activities, so the human also have the risk of accidental or any of the problems. So when it is being like that, so we have to take the health insurance policy is good. So all the people are nowadays taking the health insurance policies abundantly. Here, the types of policies, the types of health insurance policies, the three types of the health insurance policies are there. First one is the individual mediclaim. The individual mediclaim covers the hospitalizations expenses for an individual up to the some assured limit. So on the basis of our premium paid, we can take the insurance policies as the individual persons. Next, family floater policies. So the family floater policy covers the hospitalization expenses for the entire family up to the some assured limit. So the every insured also has some of the limited amount already agreed in the policies. Otherwise the full mediclaim amount. Next, unit linked health plans. This policy combines health insurance with the investment and pays back an amount at the end of the insurance terms. The health insurance provides in two ways of coverage. First, it will provide the medical expenses. So, on the basis of unit linked health plans, the insurance company covers the expenses of hospitalization nursing home bills, and doctor services. Otherwise, the disability income. It replaces the income lost while the insured is unable to work. So under this plan, the insurance companies also provides the all the fees made by the hospitals and the doctor fees. And not only that, it will provides also some of the income lost by the assured in the time of taking the treatment. Next, how the claims are going to settlement. So in the two times we can settle the premium amount or the claims. First, the claims amount need to be approved by the TPA and the hospital settles amount with the TPA. So the third party administrator is a middle between insurer and the customer. So the claim, so the insurance agents are there, So they by the way of insurance agent, the claim amount need to be approved. So the approved by the agent only we can get the claim. Next, reimbursement. The insured avails himself or herself of the treatment and settles the hospital bills directly at the hospital, and the insured can claim reimbursement later on by the submitting relevant bills document for the claim amount to the PT. So, but most of the hospitals will never claim the fees from the insurance companies. So, first of all, the patients or the assured has to pay the amount to the hospitals. After that, by submitting the bills of the hospitals to the insurance companies, the assured can claim the insured amount from the insurance company. Next, miscellaneous insurance. So, other types of the insurance. In the other types of the insurance, first one of the insurance is motor vehicle insurance. This is also known as auto insurance. This policy comes under the general insurance. This insurance has become very popular and is gaining importance. According to the motor insurance, the owner's liability to compensate people who were killed or injured through an accident is passed on the insurance company. So normally when we are riding the bicycle, when we are riding the motorcycles and the cars or any of the vehicles, some of the accident may or may not happen. Suppose when any of the accidental is made, and because of that if any of the third persons are dead or injured, so that third party have the rights to claiming the amount from the assured. So on behalf of the insured, the insurance company will compensate the loss of the third party. Next, burglary insurance. This policy comes under the category of insurance of property. Any loss of damage due to the theft, larceny, burglary, house breaking, and acts of such nature are covered. Nowadays, the thieves are increasing day to day. So all the peoples want to protect their properties in their home and the vehicles and some of the worthy goods. So the compensation of actual loss is done. So the insurance company will compensate the loss of theft. The insurable interest need not exist at the time of policy but should be present at the time of theft. Suppose normally when we have protect, when we hold our ornaments in our bureau and our locker, we will never feel the insurable interest because the ornaments always will be as a ideal. But when we are launching that ornaments, we will must get the insurable interest. Next, the principle of causa proxima is also applied to it. because when we are sleeping in the home, if you are not listening about the theft, so the insurance company will not have the responsibilities, and we have to take some of the effort to reducing the theft, so only we can get the chance to compensate the burglary insurance. Next, cattle insurance. This is a bond in which a sum of money is secured to the insured in case of an event of death of animals like bulls, buffaloes, cows, and heifers. The cause of death may be an accident, disease, or pregnant conditions, etc. The insurer normally agrees to pay excess in the case of losses. So many of the peoples are having the many cattle like cow, camels, and buffaloes. So they also can have some of the risks by the way of accidental or disease and the pregnant conditions. So when the cattle are getting any of the losses, we can claim from the insurance companies. Next, crop insurance. This policy is to provide financial support to the farmers in case of a crop failure due to the drought or flood. It generally covers all risk of loss or damages relating to production of rice, wheat, mills, oil seeds, and pulses, etc. Now, many of the farmers also cropping the insurance like that the money crops like the tobacco and oil seeds and the rice, wheats, etc. But if a farmers only depending upon the cultivations, they have more chance to get the loss. Suppose if they are getting losses, he can compensate from the insurance company in the case of crop insurance. Next is sports insurance. So this policy is comprehensive cover for amateur sports persons regarding their sporting equipment, personal effects, legal liabilities, and personal accident risk. So nowadays all the sportsmen are able to or the ability to join in the amateur sports. So when they are participating in any of the sports, they are also have some of the possibilities to affect the from the risks. So when he are playing, they can get some of the accident and their legs may break and some of the injury will happens and something, etc. And some of the sportsmen also can have the interested against the protection of their equipment, because now the amateur sports persons always will have the high priced equipment on the sports. So when the equipments of sports is thieved against the thief, they can be able to claim the compensate from the insurance company. And if they are getting injured when they are playing, also they can get the claim from the insurance company. Next, Amartya Sen Yuksan Yojana. This is one of the policies named by the government. So the general insurance company offers to secure the education of dependent children under this policy. If the assured parents, legal guardians goes through any bodily injury resulting solely and directly from the accident due to external, violent and visible, and if such injury shall within 12 calendar month of the occurrence. Some of the students are going to get injured and they dead, and when the students are going to dead or get the injured, their parents and their guardians can have the claim from the insurance company. Okay students, I think it's enough. So if you have any doubt, please ask me, and just you take the miscellaneous insurance as your study process. Thank you.